Welcome to the Investment Basics webinar sponsored by IBM SECU Financial Planning and Investment Services. Your phone will be muted during the presentation, but we will have a Q&A session at the end. Simply enter your questions into the chat window throughout the presentation, and we'll ensure that they're answered during the Q&A session. We've also included a workbook on today's webinar that is available to you upon request for you to share with your family. So let's get started. I'd like to introduce today's speaker, Claire Hart. She is a financial advisor with IBM SECU Financial Planning and Investment Services. She's been in financial advising for over 20 years, and she brings a wealth of experience. So let's get started with today's webinar. I'll turn it over to you, Claire.
Thank you very much for the introduction, Stephen. I appreciate you having me here today. Good afternoon. My name is Claire Hart, and as Stephen said, I've been in the financial service business for 20 years, and I am one of the financial advisors here at IBM Financial Planning and Investment Services. In this presentation, we're going to discuss the basics of investment planning. We'll start by discussing some fundamental investment concepts. Then we'll review some of the investment options that are available to you and consider some general investment strategies. Finally, we'll spend some time discussing how you might go about allocating your investment dollars. In the end, I hope that this overall review will assist you in thinking about your own investment needs and may help determine whether it might be beneficial for you working with a financial planning professional. So to begin, let me pose a question. What does investing mean to you? Does investing mean speculating? Some of you may associate in stocks with speculation, like gambling on the volatile or uncertain value of assets in the hope of obtaining potentially high returns. For example, trying to time the market in order to make a quick profit. Others may see investing as more long-term, methodical effort to save for the future. In fact, it's a little of both. All investing involves a certain amount of risk, including the potential loss of principal, but there can be no ironclad guarantees that any investing strategy will be successful. Investing involves the potential growth of your money over time. Consider investing a carefully planned and prepared approach to managing and accumulating money. Investment planning is about discipline and patience, but it doesn't have to be difficult. An important concept to understand when it comes to investing is the impact of inflation. Inflation has the effect of reducing the purchasing power of your dollars over time. According to the U.S. Department of Labor, the average annual rate of inflation since 1914 has been approximately 3%. At 3% annual inflation, something that cost $100 today would cost about $181 in 20 years from now. So let's say you put $200,000 in your mattress, assuming 3% inflation. That $200,000 would buy you just over $108,000 worth of goods in 20 years from now. That's less than $60,000 in purchasing power in 40 years. That means that your investments aren't keeping up with inflation. You're actually losing purchasing power each year. It also means that your real rate of return on your investment may actually be less than what you think. Something you need to take into account. Inflation has the general effect of reducing the real value of your investments over time. But compounding has the exact opposite effect. Anyone who has a saving account understands the basics of compounding. The funds in your saving account earn interest, and that interest is added to your account balance. The next time interest is calculated, it's based on the increased value of your account. In effect, you earn interest on your interest. Many people, however, don't fully appreciate the impact of compounding earnings can have, especially over a long period of time. Let's say you invest $5,000 for 30 years. After 30 years, you will have invested $150,000. Yet, assuming your fund grows at 6% a year, because of compounding, after 30 years, you'll have $395,000. Now, let's talk about the rule of 72. This is a quick way to help you estimate how long it will take for your investment to double. Simply divide the number 72 by the rate of return in which your investment increases. So for example, if you have a 6% return, you take 72 and divide by 6%, and you get the number of years it would double. So in this example, with a 6% return, it would take 12 years in order for that investment to double. If you had a 3% return, it would take 24 years. The sooner you start saving, the better off you are. So don't put off investing. Playing catch up later can be difficult and expensive. So in this example, you will see the earlier you start, the better you are. For example, investing $3,000 at the end of each year, starting when you were in your 20s, and you will have accumulated about $680,000, again assuming a 6% annual growth rate and no tax, by the time you are 66. But if you wait until you're 35 and start investing $3,000 annually, you'll only accumulate about $254,000. And if you wait until you're 45, you'll accumulate only about $120,000 by the time you're 66. It's never too late, so don't be discouraged. I'm simply trying to illustrate the importance of acting sooner rather than later. The first step in any investment plan is to identify your goals. Why are you investing? Is it for retirement, education, a special purchase, financial security? So we have short-term goals and we have long-term goals. Perhaps it's for the down payment of a house or a new car. Still others invest to build a fund so they can access for unanticipated financial needs, an illness, an accident, a job loss. Of course, you may have all of these things in investment goals, and something that I haven't even mentioned. If you do have multiple goals, think about how you're going to prioritize them. Once you've identified and prioritized your investment goals, consider the time horizon associated with each goal. Generally speaking, and all things being equal, the longer your time horizon, the more aggressively you may be willing to invest. That is, investments that carry more risk because they offer greater potential for return will tend to be more appropriate for those with long-term time horizons than those with short-term time horizons. Why? The longer the investment horizon, the more time you have to recover from any investment losses. The world of investing is a very sensitive place. The investment plan that's right for you depends largely upon the level of comfort that you have when it comes to risk. You can't completely avoid risk when it comes to investing, but it is possible for you to manage it. There are two aspects of risk tolerance to consider. The capacity of your investment plan itself to absorb losses, and how comfortable you are with risk personally. The first aspect can be quantified. The more flexibility your investment plan has when it comes to potential loss, the more risk your plan can tolerate. For example, as we discussed, a long-term time horizon may allow you to take more risk than a short-term time horizon. The second aspect, how comfortable you are personally with risk, is more of an emotional measure and depends on many factors, including your objectives, your life stage, your personality, and your investment experience. Some investors are comfortable with a high degree of risk, while others can tolerate only a minimal risk. Your individual risk tolerance is an important factor in deciding which individual investments are appropriate for you, and as well as your investment dollars should be allocated among different investment classes. Investors are typically grouped into three major categories of discussing risk. Aggressive, those that have a high degree of risk tolerance. Moderate, those willing to accept some degree of risk. And conservative, those who are risk adverse. When it comes to investing, there's a direct relationship between risk and return. In general, as the potential for returns increase, so does the level of risk. Another way to state it, the less risk an investment has, the lower the potential for return. So, for example, putting your money into a bank CD may have little risk, but it also offers less potential for return than purchasing a common stock. That is very true for an investment portfolio as well for individual investments. The more aggressive you are as an investor, the more risk that you're willing to take means the more potential you have for greater returns, but also means a greater chance of loss. Conversely, the more conservative you are as an investor, the less risky you're generally comfortable with, means lower returns and less likelihood of loss. This is known as the risk-return trade-off. As much as we like it, we can't have it all. There is a relationship between growth, income, and the stability of our investments. And when we move closer to one, we automatically move away from another. There is a dilemma that we all investors face. The key is to try to maximize return at a level of risk that you are comfortable with. There are several general categories of investments to choose from and countless specific investment options within each category. We're going to discuss just a few. Cash alternatives, such as bonds, stocks, other investments, and mutual funds. Before we start talking about investment options, however, let's take a moment to clear up a common misconception. Some of you may think that your 401k at work is an investment. It is not. A 401k plan is a tax-advantaged vehicle that holds individual investments. The same goes for IRAs, 529s, Coverdales. Think of these as tax-advantaged vehicles as buckets that can be filled with individual investments. Investments are held in these vehicles get different tax treatment than investments held outside these vehicles. We're not going to discuss the tax treatment of investments today, however. So it's an important subject, especially since the tax treatment of long-term capital gains and qualifying dividends is typically more favorable than that of ordinary income. Since you need to understand the different investment options are taxed to make good decisions, you should discuss that issue with a financial professional or tax professional. First, we're going to discuss cash alternatives. These offer low risk, they're short-term, and relatively liquid. In other words, you can convert them to cash quickly if needed. You might use cash alternative to provide you with relative stability, to maintain a ready source of cash for emergencies and other purposes, to serve as a temporary parking place for assets when you decide where to put your money longer term. Examples of cash alternative include certificates of deposit, money market accounts, money market mutual funds, U.S. Treasury bills. Also, be sure to understand the type of protection available with each one of these. There are advantages and disadvantages to each one. Advantages, predictable earnings, high liquidity, little risk to principal. Some of the disadvantages, relatively low returns, may not keep up with inflation. The next type of investment we're going to discuss are bonds. Bonds are essentially loans, which is why they're called a debt instrument. You, the investor, lend money to a government or a corporation. The interest rate or coupon rate, which can be fixed or floating, is set in advance, and interest payments are generally paid semi-annually, but they can also be paid monthly or quarterly. Bonds are issued in denominations as low as $1,000. In addition to a set interest rate, the maturity date is fixed, ranging from 1 year to 30 years. However, bonds don't need to be held until they mature. Once issued, they can be traded among other investors like any other type of security. Because you can buy and sell bonds in the open market, bonds fluctuate in price, selling at or above their face value. If the interest rates rise, new bonds and investment options are offered with higher interest rates, and existing bonds with lower fixed interest rates become less appealing. So when interest rates rise, existing bonds generally decrease in value. In contrast, when interest rates fall, existing bonds generally increase in value. Generally, the longer a bond's duration to maturity, the more volatile in price swings. We have several different kinds of bonds. We have U.S. government securities, agency bonds, municipal bonds, and corporate bonds. U.S. government securities are backed by the full faith and credit of the United States government and therefore carry minimal risk. We've talked about U.S. Treasury bills, but other securities include Treasury notes, Treasury bonds, which pay interest semi-annually. You can also invest in bonds that are issued by agencies or sponsored by the U.S. government, which may or may not have the backing of the U.S. government depending on the agency. Municipal bonds are issued by local governments of states, cities, or towns. Specific authorities like a state transportation authority may also issue bonds. Corporate bonds are issued by private companies. The volatility of these bonds depend upon the companies that issue them and can carry a range of very stability to highly volatile, so-called high-yield or junk bonds. Some corporate bonds are convertible and can be exchanged for a share of the company's stock. You can also purchase zero-coupon bonds that are issued for a discount below face value. No interest is paid, but at maturity, you receive face value of the bond. For example, you might pay $600 for a 5-year, $1,000 zero-coupon bond. At the end of the 5 years, you would receive $1,000. So what are the pros and cons of bonds as an investment? Let's take a look. Steady and predictable stream of income. Typically higher than cash alternatives, relatively lower risk compared to the options such as stock, and have low correlation to the stock market. What are the disadvantages? We have the risk of default. The company may be in financial trouble and they might default on the bond, which means that they will not pay the interest or the principal back. The value of the bond will fluctuate with interest rates. But if held to maturity, it will pay back par value. Lower risk means lower potential for returns than a stock, for example. The next option we're going to talk about is stocks. When you buy company stock, you're actually purchasing a share of ownership in that business. The greater the number of shares you own, the higher the percentage of ownership you have in that company. Investors who purchase stocks are known as company stockholders or shareholders. Your percentage of ownership in a company also represents your share of risk-taking and profits generated by the company. If the company does well, your share of the total earnings will be proportionate to how much of the company stock you own. The flip side, of course, if your share in any loss will be similarly proportionate to your percentage of ownership, though you are not personally financially responsible for any share of the liabilities of the company in which you hold an equity interest. Beyond that, depending on the company and the types of shares you have, stock ownership may carry other benefits. Specifically, you may be entitled to dividends, which can generally receive either in cash or additional shares, capital gain payouts, and other corporate privileges. For example, common shareholders have the right to vote for candidates for the board of directors and other important issues. If you purchase stock, you can make money in one of two ways. First, corporate earnings may be distributed in the form of dividends, usually paid quarterly. Second, you can sell your shares. If the value of the company's stock has increased since you purchased it, you will make a profit. Of course, if the value of the stock has declined, you will lose money. There are two different types of stock, common versus preferred. Corporations that issue common stockholders have many rights, so including the right to vote. However, common stockholders are the last in line to claim earnings or assets of the company. They receive dividends at the discretion of the board of directors and only after all other claims and profits have been satisfied. Preferred stockholders are given priority over holders of common stock when it comes to dividends and assets. However, the preferred stockholder does not receive the privileges of ownership given to the common stockholder, including the right to vote. Preferred stockholders typically receive a fixed dividend payment, usually on a quarterly basis. For preferred stockholders, there is less return potential than for common stockholders, and there's also less risk. The common stockholder benefits when the company does well, but they may lose more money if the company does poorly. Stock is commonly categorized by the market value of the company that issues the stock. For example, large cap stock describes shares issued by the largest corporation. Other general categories include small cap, mid cap, and micro cap. Just to give you an example here, back in the 80s when Microsoft was just getting started, he would have been considered a small cap company. If people hadn't given him a chance, he would have never became a mid cap company and then the large cap company that he is today. Stocks are also commonly classified according to the characteristics of the company or the expectations for the investors. For example, we have growth stocks, which are usually categorized by the earnings that are increasing at a faster rate than their industry average or the overall market. These are often new and fast-growing industries or frequently have potential to give shareholders greater returns than those offered by the stocks of companies of older, more established industries. Growth stocks are among the most volatile class of stocks. However, they have a significant risk for loss. Value stocks are typically characterized by selling a low multiple of the company's sales, earnings, and book value. Income stocks generally offer dividends, yields than the market average, and they typically fall into the utility and financial sector as well as other stable and well-established industries. An example of an income stock would be FP&L. Blue chip stocks are stocks of large, well-known companies with good reputation and strong records of profit growth, and they generally pay dividends. Companies in this category would be IBM, Home Depot, Apple, Microsoft, United Healthcare, Philip Morris, just to name a few. It's also worth mentioning our American Depository Receipts, or known as ADRs, which are negotiable instruments created to represent shares of stock of non-U.S. companies. So international stocks. What are the advantages and disadvantages of owning stocks? Well, historically, stocks have provided the highest long-term returns. So they have been particularly true for long-term periods. With stocks, you actually own a share of the company and therefore have ownership rights, which may include voting rights. You can invest in the stock that has a history of paying regular dividends. You can also invest in a stock that has potential to appreciate significantly in value. And stocks are easy to buy and sell. Of course, if you invest in a company and it performs poorly, it may not pay a dividend, even if it did pay regular dividends in the past. More importantly, though, poor performance may result in your shares losing value. In fact, your shares can lose value simply because they're subject to general volatility of the stock market, which has experienced sharp declines in the past. This volatility means that your risk of losing principal is greater with stocks than it is with bonds and cash alternatives. It also means that the stock may not be appropriate for short-term investment timelines unless you have a high tolerance for risk. There are a few other investment options that you can consider, such as real estate, stock options, futures, commodities, and collectibles. Because this is a basic investment discussion, we're not going to spend any time on these other investments, but I'd be happy to discuss them with you later if you'd like. What is a mutual fund? A mutual fund represents a way to invest in stocks, bonds, or cash alternatives. The principle behind a mutual fund is really quite simple. Your money is pooled along with the money of other investors into a fund, which then invests in certain securities according to a stated investment strategy. The fund is managed by a fund manager who reports to a board of directors. By investing in the fund, you own a piece of a total portfolio, which could include anywhere from a few dozen to a few hundred securities. It provides you with both a convenient way to obtain professional money management and distinction that would be more difficult and expensive to achieve on your own. There are three major categories when it comes to mutual funds. You have money market funds, bond funds, and stock funds. Commonly named and classified according to their investment objectives. A fund that invests solely in cash alternatives are generally called money market funds. Funds that invest solely in bonds are called bond funds, and not surprisingly, funds that invest in stocks are called stock funds. Stock funds can also be classified based on the size of the company in which they invest. Large cap, mid cap, and small cap. Of course, there are many other types of mutual funds. For example, funds that invest in both bonds and stocks are often called balanced funds. In fact, there are mutual funds that fit along all risk-return spectrums. There are international funds, which seek investment opportunities outside the United States. An actively managed fund is where the manager uses his or her knowledge and research to actively buy and sell securities in intent to beat a benchmark, where a passively managed account, which is typically an index fund, typically buys and holds most or all of the securities to represent a specific index, for example, the S&P 500. The objective of the index fund is to obtain the same rate of return as the index. Although the name of a mutual fund sometimes offers insight into the investment style and the objective, don't rely on the name to determine whether the particular fund is what you want. You should read the fund's prospectus before considering investing. The advantages and disadvantages of mutual funds. First of all, you have instant diversification. You have professional money management, and you only need a small amount to get started. They also provide liquidity. What are some of the disadvantages? Well, just like a stock, The value of these shares can fluctuate on a daily basis. The proportion of fund dollars may be tied up in cash for liquidity needs, potential tax inefficiency, and mutual fund fees and expenses. So these include sales charges and annual operating expenses for running the funds. Another investment option are exchange-traded funds. Like a mutual fund, an exchange-traded fund pools your money with the money of other investors and collects and buys securities. However, some of the key differences you need to understand. Most ETFs are based on an index. So the fund's investment choices typically don't change unless the index changes itself. That passive management style and relatively infrequent trading does help reduce the fund cost. And this way they're a bit like an index mutual fund. ETFs have passive management style that can be very useful to investors who want to trade actively. For example, an ETF can be traded throughout the day, and its price may fluctuate as a result of that activity, just like a stock. This is different from a mutual fund, which is priced once a day after the market closes. Also, an ETF can be bought on margin and sold short and trade using stop orders and limits, just like a stock. ETFs are one way to invest in an individual market segment or industry without limiting yourself to a single stock or bond. Finally, because they trade relatively infrequently, ETFs may offer other tax efficiencies. For example, they may make lower taxable annual distributions to shareholders. Like a mutual fund, each ETF publishes a prospectus, so get a copy before investing. Let's talk about dollar cost averaging. Many investors utilize an investment strategy called dollar cost averaging. Most of us do this in our 401k. With dollar cost averaging, rather than investing a single lump sum, you invest smaller amounts of money at regular intervals, no matter how the market is performing. Your goal is to reduce the overall volatility of your portfolio by purchasing more shares when the price is low and fewer shares when the price is high. Although dollar cost averaging can't guarantee you a profit or avoid a loss, a regular fixed investment may result in a lower average price per share over time, assuming you continue to invest through all types of markets. You should consider your financial availability to make ongoing purchases regardless of price fluctuations. For example, let's say you decide to invest $300 a month towards your child's education. Because you invest the same amount each month, you automatically buy more shares when the price is low and fewer shares when the price is high. Over time, you'll find that your average cost per share is actually less than the average market price for these shares at the time that you invested. If you're currently contributing automatically to a 401k, you're already doing dollar cost averaging. Asset allocation. It is almost universally accepted concept that any portfolio should include a mix of investments. That is, a portfolio should contain investments with varying levels of risk to help minimize exposure. Many investors make the mistake of putting all their eggs in one basket. For example, if you invest in one stock and that one stock goes through the roof, you've made a fortune. On the other hand, if that stock goes down, you might have lost all your money. Diversifying your investment in several asset classes will reduce your risk of losing your entire investment. Keep in mind, through that diversification cannot ensure a profit or guarantee against a loss. Asset allocation is one of the first steps in creating a diversified investment portfolio. Asset allocation is the concept of deciding how to invest your investment dollars among broad investment classes such as stocks, bonds, and cash equivalents. The underlying principle in different investment classes have shown different rates of return and levels of price volatility over time. Also, since different asset classes respond differently to the same news, your stock may go down while your bonds go up, vice versa. Diversifying your investments over different asset classes may help you lower your overall volatility of your portfolio. So how do you choose the right mix for you? A number of resources are available. Most of these take a number of variables into consideration. Some of them, your objective, your age, your financial resources, your time frame, your liquidity. Some are subjective, like your tolerance to risk, your outlook on the economy, and suggest a possible asset allocation. You want to choose a mix of investments that has the potential to provide the returns that you want at the level of risk you feel comfortable with. For that reason, it often makes sense to work with a financial professional to help you tailor a portfolio that's right for your situation. We're going to go through a couple different portfolios. So a conservative portfolio might look like this: 25% cash, 25% stock, 50% bonds. A moderate portfolio might look like this, or what I would call a balanced portfolio: 50% stock, 40% bonds, 10% cash alternatives. While an aggressive portfolio might be 75% stock, 15% bonds, and 10% cash alternatives. The role of a financial professional here at IBM Southeast Credit Union Financial Planning and Investment Services: we can help you determine your investment goals, your timeline, and your risk tolerance. We can help you create an asset allocation model that's right for you. We can help you select specific investments. And lastly, we'll manage, monitor, and modify your investment portfolio. So, as you've seen, there's a lot to consider when it comes to investing. And if you don't have the time, confidence, or inclination to put together an investment plan, then you may benefit from help and advice of a financial professional. And I would like to welcome the opportunity to meet individually with each one of you to address any specific concerns or questions that you might have. Thank you very much for your time today. You've been a wonderful audience, and we'll now open it up for